A highly polished and tightly wound financial system rarely provides a warning before it undergoes a sudden structural fracture. On August 28, 2026, U.S. financial markets experienced a pronounced consolidation as participants integrated hawkish monetary guidance against a backdrop of bifurcated economic data. The S&P 500 closed down 0.31%, while the tech-heavy Nasdaq 100 slid 1.06%. This session represented a fundamental repricing that exposed a massive divide in the macroeconomic landscape. Household consumers are rapidly contracting as elevated borrowing costs and persistent price pressures erode real buying power. Simultaneously, the corporate capital cycle is expanding aggressively. This expansion is driven by secular investment in artificial intelligence infrastructure, which now accounts for more than half of the growth in business equipment spending. On this same day, a hawkish policy address in Jackson Hole triggered an aggressive yield curve twist in sovereign bonds. This twist involves the contradictory compression of term premiums at opposite ends of the yield curve. The August 28th price action provides the empirical map required to navigate this strictly bifurcated capital cycle. Economic data released in late August highlights the growing distance between industrial activity and household health. The Chicago Business Barometer fell to 47.1, signaling a contraction in regional manufacturing that missed consensus expectations by over 10 points. This industrial slowdown coincided with the University of Michigan Consumer Sentiment Index falling to 51.7. This line chart tracks sentiment declining to 51.7, with 53% of consumers reporting finances damaged. Conversely, corporate profits expanded 22.8%. This gap, the macro divergence, represents companies raising prices faster than input costs, even as consumers cut discretionary spending. Gap Inc. illustrated this resilience in its Q2 report, delivering a merchandise margin expansion of 1,220 basis points. These striking metrics track a zero-sum transfer of wealth from a constrained consumer to an AI-driven enterprise sector. The narrative and geographic focus shifted to the Kansas City Fed's Economic Policy Symposium in Jackson Hole. Fed Chair Kevin Warsh delivered a disciplined debut keynote, clarifying a hawkish stance on the price stability mandate. Warsh noted that disinflation has stalled, with 54% of the personal consumption expenditures basket rising by more than 3% over the past year. To address this sticky inflation, Warsh announced the phase-out of the Fed's practice of providing explicit forward guidance in normal economic conditions. Warsh described a Hall of Mirrors problem. Markets had become conditioned to react to the Fed's projections rather than analyzing economic data. Ending forward guidance shatters that loop, forcing participants to price risk based on raw economic metrics without the safety net of central bank telegraphing. Removing this protective mechanism directly exposes asset prices to more frequent and intense shocks from untelegraphed data releases. Warsh's remarks triggered an immediate and sharp repricing across the sovereign bond market. Short-duration treasuries sold off as investors adjusted to higher near-term policy expectations. The implied probability of a 25 basis point interest rate hike at the September FOMC meeting surged from 35.4% to 57.5%. This repricing pushes the two-year Treasury yield up by as much as 7 basis points, past the 4.32% mark. Despite these rising hike odds, the long-term 30-year bond yield declined to 5.16%, resulting in a dramatic flattening of the curve. Direct fiscal intervention from the Treasury Department engineered this long-end drop. To manage borrowing costs, the Treasury doubled its debt buyback program to a minimum of $4 billion per transaction, targeting older, long-dated government debt. This intervention places an artificial ceiling on long-term rates, even as the national deficit continues to expand. This yield curve twist reflects monetary and fiscal policies pulling in opposite directions, creating a compressed and fragile term premium. This high-yield environment acted as a sorting mechanism for individual equities. The market applied intense scrutiny to the monetization timelines of high-multiple technology stocks. This scatterplot compares price changes against monetization speed. Okta surged 28% as AI security tool adoption drove a 14% increase in remaining performance obligations. NVIDIA remained a structural anchor in this quadrant, reporting $96.2 billion in revenue and guiding for $70 billion. The Federal Reserve's transition away from forward guidance concentrates market volatility around major economic releases. This environment creates a clear tactical mandate: maintain a defensive stance on consumer discretionary stocks while concentrating capital in the enterprise AI build-out.